You've seen the rebalance on a broker and wondered what it actually means. You log into your investment account and there it is. Time to rebalance, or a button that says rebalance portfolio. But what does that really do? By the end of this video, you'll know what rebalancing is, how it works, and why it's important. What is rebalancing? Rebalancing is simply adjusting your investments to match your original plan. Over time, some assets grow faster than others, which can change your risk level. Rebalancing brings everything back in line. Many brokers even show you when your portfolio is out of balance and suggest how to fix it. So, how does rebalancing work? Rebalancing works by bringing your portfolio back to the investment mix you originally planned. For example, you might decide to invest 60% in stocks and 40% in bonds. Why 60-40? The 60-40 portfolio is a classic starting point for many investors. Stocks offer long-term growth, but they can be volatile. Bonds, on the other hand, are usually more stable and provide steady income. When combined, they create a mix that balances risk and reward, helping your money grow while reducing the ups and downs. But over time, stocks might grow faster than bonds, and after a while, your portfolio could shift to 75% stocks and 25% bonds. That's more risk than you signed up for. To fix it, you rebalance, which means selling some of the stocks and buying more bonds to get back to the 60-40 split. Another way to rebalance is by adding new money to the underweight asset, in this case investing new cash into bonds instead of stocks. Most people rebalance either once a year or whenever their portfolio drifts too far from their original mix. It's a simple step that helps you stay in control. But rebalancing isn't just for stocks and bonds. Many portfolios include other assets like international stocks, real estate, emerging markets, or commodities. For example, you might have 30% in US stocks, 20% in international stocks, 30% in bonds, and 20% in real estate. If international markets have a strong year while bonds lag, that 20% international portion could grow to 30%, shifting your overall risk and exposure. Rebalancing in this case means trimming the outperformers and adding to the underperformers to bring your portfolio back to its original plan. It prevents you from being overexposed to one region or asset class just because it recently did well. Why is it important? Rebalancing is important because without it, your portfolio can quietly drift into a risk level you never intended. For example, if stocks do really well for a year, they can take up a much larger portion of your portfolio, which means you're now more exposed to a stock market crash than you planned to be. This can lead to bigger losses during downturns. Rebalancing brings things back in line by trimming the parts that grew too much and adding to those that lagged. In doing so, you're naturally selling high and buying low, taking profits from the assets that have gone up and reinvesting in ones that are still reasonably priced. Over time, this disciplined habit can improve your long-term returns and reduce big swings in your portfolio. But most importantly, rebalancing keeps your investing strategy on track. Without it, you might end up holding a portfolio that no longer matches your goals or risk tolerance. Conclusion. In short, rebalancing is about checking your investments and making small adjustments to stay aligned with your original plan. It helps you manage risk, lock in gains, and avoid drifting too far off course. Whether your portfolio is simple or includes a mix of global assets, rebalancing helps you stay in line with your risk level, time horizon, and long-term goals. And the best part, you don't need to be a financial expert to do it. Just review your portfolio once or twice a year and make simple changes if things are out of balance. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.